And a welcome to the Investor Coaching Show. Paul Winkler. Talking about the world of money and investing. Now, I did a video this week. And I like to talk about the videos because it's a great way to, well, number one, have visuals from time to time. But I like just putting out things just when there's market turmoil. That seems to be the best time to put out a video on investing, is because people are worried about, hey, what's going on? How do you put this in perspective? And I've done some videos on elections and election cycles and historically and how markets were, for years and years. Good grief, going back to 2008, 2009, I was doing a ton of videos during that period of time because everybody's so scared about the stock market. Like, what's going on? Where is it going to go? And you have to get perspective on how markets work. And, then when you own stocks, you own companies, and you're going to get the rights to the profits of the companies and how those, prices can fluctuate based on new information coming in. It was one of the guys in the radio station was just saying, hey, Paul, what's going on? What's going on with the market? Not that I'm worried, but I was just kind of curious what's going on with the market. And, it was interesting with some of the market upheaval earlier in the week. As and then of course we get this data on Thursday saying the GDP numbers are phenomenal. I mean, what's going on? Why would stocks go down with the GDP numbers? Well, it's because the GDP numbers, gross domestic product, that's the output of the U.S., it was pretty much expected that it was going to be good. So when it came in good, it was like, well, ho-hum. I mean, that's what we expected to happen. So, not news. And then, with the market down, when it goes down, you go, what is going on and what do I do about it? Well, a lot of times what I try to do is I coach people through this type of stuff because it's really easy to get just down and out about, oh my gosh, as it's going down, it's going to keep going down. And we continue patterns in our mind. If my general pattern of the stock market has been down, I continue that mentally thinking, well, it's going to keep going down. I mean, that's just, if the market's been going up, I continue that in my mind and go, well, it's going to keep going this direction. It's going to keep going up. And markets don't really have any patterns. So that's just, we call it false patterning. We look for patterns that don't really exist. I mean, that's just basically it. So I was looking around for articles about things, and I decided to, just for the fun of it, I would put a search phrase in. And it was something about, I think as I recall, it was like regret and stock market and downturn and regrets or something like that. And I just figured I'd see what came up. Well, a couple of articles came up as I was doing this search. And I had paid dirt. I really did on a couple of these things because I loved the headlines and I loved the content. And one of the articles was on lessons from past market plunges and my single biggest regret. And what was his single biggest regret? This guy, well, his regret was reacting to them. So I thought, hey, that's a good one right there, because that's really what it gets down to is when we have market, they make big moves down. We want to react. We want to go into self-preservation mode. Oh my goodness, I gotta, stop the bleeding. It's going down. Well, it's not like when you're really bleeding. When you're really bleeding, yes, you better stop the bleeding, because if you keep bleeding, you die. Well, with stock markets, don't continue. The blood doesn't keep coming out. They jump back up pretty quickly. And, as I like to share from time to time, studies show that they jump up much more rapidly than you ever imagine. If we go back and look back to the 1960s till now, 96% of returns occurred in 0.9% of trading days. Well, how many days is that? Well, if you look at the number of trading days there are in the year in the stock market, it works out to just like 2.3 days. So 2.3 days per year on average give us all the return of the stock market historically, and it just seems mind-boggling. How can that be? That's huge. Well, that's just the way it is. So this guy was just making the point. He says, my biggest thing was, reacting them. He says it may be patronizing to be told that falling markets are a good thing because you can buy at bargain prices, but 10 years from now, you'll marvel at the deals you got on stocks bought during a plunge. And, the reality of it is the vast majority of 10-year periods in all of history, I mean, you can only go back to the Great Depression and find one where there was no return. The vast majority of 10-year periods, you have a higher valuation on stocks 10 years later. And it's not, you don't have to wait 10 years, the vast majority. You look at it and say, well, most of the time markets recover from downturns in 111 days on average, historically. So you don't even have to wait 1 year most of the time when markets go down for markets to be at a higher price. 111 days. That's it. That's not much. So, that was good and everything. And I commented on that. And I was just talking about how, you may not necessarily want to go and stick all your money in cash. And, people that do that, they go and they stick their money in cash and they go, well, I'll get back in when things look better. And of course, things look better. Markets go up so rapidly, you can't get in on time. And the reason is because of psychologically, think about this. You got stocks go down and they go down and then you go, oh man, I got to get out. I've got to get out. This is crazy. I've got to get my money out of the stock market. I got to get out. And then you get out and then, the market goes up a little bit. You go, oh man, maybe it's a good time to get back in because, well, it looks like it's starting to recover. And then it goes down and you go, whew, boy, I'm glad I didn't react. I'm glad I didn't do anything, when I saw stocks go up because, man, I almost bought and then I would have bought and then it went down again. And then it goes up a little bit and you go, oh, well, no. You fooled me last time. Not going to fool me again. And the stocks go back down. God, geez, see, I'm smart. Look at that. I stayed out. And then the stocks go way up. And then you hear people say, well, it's a sucker's rally. It's a term that means that only suckers will buy after the market goes back up. And it keeps going up. And then it maybe goes down a little bit. And you go, well, when it gets back down to where it was before, then I'll get back in. And then it goes up precipitously. And you sit there and go, oh no, what have I done? I've missed. And this may happen over a period of years. I mean, I made it sound like it may be just a couple of days, but it could be a period of years that this kind of stuff happens. And this is why people miss out on the upturns. And that's why market timing is so crazy, because you have to be right twice. You got to be right when you get out and you got to be right when you get back in. And, as he was saying, he didn't know. Well, people put money in cash and they think, well, this is safe. Well, one of the things I pointed out in the videos is there was this article, and it was UK government borrowing soars to record high during COVID pandemic. What's going on here? UK government borrowing soared in the record high in the 6 months of the financial year as extra spending needed to tackle COVID-19 pandemic pushed the public deficit further into the red. Now, what does that have to do with anything? Well, when you start to see this kind of borrowing and this kind of money flowing in, you can actually have, because of government borrowing, a great demand for cash, right? So you have this great demand for cash, whatever cash is out there, and then all of a sudden you can start to see interest rates start to jump back up as time goes on. But here's the bigger deal: inflation. When inflation kicks up, because all of a sudden the price of things actually starts to accelerate, and then all of a sudden you, with your money in fixed income investments, and some of you are locking it up for years, in order to get higher interest rates, or you're locking it up in investment vehicles like annuities and insurance contracts that have borrowed or have lent money to people borrowing for multiple years. So you can think about it. When an insurance company invests in bonds, they're typically not investing all their money. They're not. In treasury bills, which are really, really short-term interest-bearing notes, and they technically are sold at a discount, but they're very, very low yielding because the money is in there for such a short period of time. No, what an insurance company is doing is buying longer-term bonds to get a little higher interest rate. Well, those interest rates that they got, they basically have locked this money up for years. And, if all of a sudden we have this inflation And then all of a sudden with the inflation comes higher interest rates. Well, what happens to bond prices? Bond prices go down, which is what the insurance company invested in. Now, if we look at this whole picture here, we could see where the devaluation of currency could significantly happen. And you don't know, I'm not predicting anything. I don't know when that's going to happen, but I'm going to tell you that when you pull money out of the stock market and you stick it in fixed income investments, you are A, market timing, but B, you're expecting that what you put the money in is going to do better than what you pulled it out of, which is a really scary proposition. So, you got to really, you really have to think twice when you do these types of things. Now, the other thing I talked about in the video was this article. They sold stocks and lived to regret it. Now, this was a little bit of an older article, which makes it kind of interesting because it was written in 2006. Okay, so those of you that have followed market history over the past several years, you kind of know what's been, what happened in the market in late 2007 and 2008, and then early 2009, right? Big market downturn, right? Well, check this out. What happens in this particular case, this lady that they started off the article talking about, she bought 10,000 shares. Now, she didn't just go, put a couple dollars down. She put a significant amount of money down. 10,000 shares buying Amazon stock. Amazon at $16 a share. That's $160,000. I mean, that's not, not pocket change by any stretch of the imagination. Well, what happens is, the stock drops. So she's basically $16. It drops, 25%. Goes down to $12 a share. So you can imagine she's just like, what on earth have I done? Oh my gosh, this is crazy. I just want, and she's probably hyperventilating, putting the bag over her mouth and breathe in. But you can imagine just the panic, watching that much money just dry up on you. So, like, bam, $40,000 out the window, right? So she goes and sells it, nervous. And I made the point in the video. I said, well, let's see. Amazon, it's over $3,000 a share now, right? It was when she did this, it was 16. You can imagine 16, 3,000. So you look at that and go, oh my goodness. And before you go out there and buy individual stocks thinking you're going to hit the next Amazon or whatever, realize that what the media always does is they pick the real big winners to just really make their point about regret or greed or, whatever they're trying to get across. So that is not the message that I'm trying to put out there. But the message is that this person, sold stocks and she ended up regretting it. And in reality is that's what happens often is we'll get rid of something and we're just like, just forget it. This isn't going to do anything. And what do we get rid of? We get rid of the thing that just did the worst in our portfolio in recent years or recent months or whatever. And then all of a sudden, that is just the thing that, shoots up like crazy in value. It's like in the late 90s, the thing that everybody wanted to get rid of, myself included, but I just said, no, I'm not going to do it. Just because my academic training and some of the professors that I'd studied under had convinced me that it was a really bad idea to do it. I wanted to get rid of international small companies and values, international small value. And, that area of the market, quadrupled in value over the next few years where large U.S. stocks, just did nothing. I mean, basically lost money for 12 years. So what happens is she gets nervous and gets out of it. And one of the things that's interesting about some of these companies, we did a little study on, just as an aside, on some of these companies this week. We were looking at the S&P 500 and you're going, hey, the S&P, if we look at the return, it's one of the stronger areas of the market in the past several years. And one of the things I've been talking about is how much of that S&P 500, how much of its value is just based on a couple companies. We call them the FANG M stocks, Facebook, Apple, Amazon, Netflix, Google, and Microsoft. And I actually said, hey, why don't we run the numbers and look at the data? If we look at the return of the entire market, the S&P, that part of the market, those big U.S. companies, but let's just take the return of these stocks out. And you know what happened? There was about an 11% difference in return. 11% difference in return, removing them from the picture. And you look at that and go, whoa, that is huge. It is huge. And it's because they make up so much of the index. So literally, these companies, if they go the other direction, and it's just a matter of time. Stocks go, they win for a while and then they don't win. You could have a lot of American investors, because most investors aren't terribly well diversified, very poorly, in fact, come out really, really sorry and really hurt when those stocks actually dive in value. So, that's one thing. So that was the aside. It just happened to be one of the stocks that was talked about in this article. But the other part of the article that I wanted to share with you is this one. It says, while some market watchers are reluctant to declare the bull has returned, the article says, many investors have been eager to jump back in on the investing bandwagon. Now, they're basically going, you know what, we're reluctant to declare, yeah, it's a bull market, it's back, but, I don't know. I don't know. But a lot of investors are like, yeah, man, let's get back in. The market is back. And I looked at, well, why would they feel this way? Why don't you look at some areas of the market? I just pulled up, small value stocks just as an example. From 2002. 2003, this area of the market is up 66%. 66% for small value U.S. companies. 2004, up about 24%. 2005, 7%, and 2006, another 21%. So for a combined average annual return from 2003 through that 2006, about 28, almost 30% per year. 30% per year. That's huge. Huge. So you can see why investors go, well, you know what? Maybe it's time to get back in. Look what the market's been doing. Well, do you remember what happened 2007, next year, and then 2008? And you go, okay, well, why is it that investors get such bad results? It's because of this stuff. This is literally it right here. And further on in the article, Bank of America Securities Research, and it ends up with Merrill Lynch a couple of years later, says the stock market's still a long way from irrational exuberance. Still a long way. Oh, we got a ways to go. And I don't care how big these companies are, how well they're known. I'm going to tell you something. They don't have a clue. Who knew that what was coming was coming? I mean, they obviously did not know it was coming. So when somebody tells you, and I hear it all the time, these investment people, oh, well, our research tells us this is going to happen and this is where things are going and what we see going on. And I just want to just scream and just go, stick your fingers in your ear, go, la, 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 la. They don't have a clue. They sound really sophisticated. They sound really like they know what they're doing. Oh, yeah, we're a long way from irrational exuberance, quoting Alan Greenspan. And, our valuations are looking good. And, our price to earnings ratios are looking just fine. Everything, if we look at the book values of the company, if we look at the cash flows and we look at earning estimates, and, we're a long, long ways. They don't have a clue. They don't have a clue on the upside. They don't have a clue on the downside. Just plug your ears when these people tell you, here's what you ought to do based on what just happened in the market or where the market is going. It is a waste of time. So market upturns and downturns, while they're entertaining, I wouldn't take action based on them, because typically what you end up doing is destroying your investment portfolio and destroying your financial lives. I'm Paul Winkler, listening to the Investor Coaching Show, Super Talk 99.7 WTN.